global oil production. So we covered the demand. You can see that the demand is improving. It's going to be driven by demand from China, from Asia, from India, Pakistan, Bangladesh, Middle East. With regards to production, the blue bars are OPEC production, which is organization of petroleum exporting countries. And the black line is the global production, which is non-OPEC countries. Now, OPEC is a cartel that produces about 25% of all oil. And one may ask, how come they're controlling the price of oil? When oil was at $35 per barrel, they said, we want oil to be between 75 and 80. And within a year, you have oil sitting right on 80. And they're producing only 25%, so they're a very powerful organization. You can see that despite them introducing a cut on December 2008 of 4.2 million barrels per day, they did reduce their production. However, as prices kept creeping up, they started ramping production. There are a few culprits like Iran and Venezuela, who like to take advantage of high oil, because that's pretty much what they have. And the non-OPEC producing countries, their production has been increasing, but there's a limit to it. That's going to peak. The next slide shows OPEC surplus oil production capacity. There's quite a bit of production capacity sitting idle in the OPEC countries, and it's another. This gives us a question: why is oil price so high? Last week hitting 87. If there is so much spare capacity, the spare capacity sits in Iraq and Saudi Arabia mainly. So if the global demand for oil started ramping up, they could increase the capacity quite easily. The global consumption is rising while non-OPEC production is falling, and that's the important fact. Since OPEC can control prices via the production, we need to look at a global consumption versus non-OPEC production, and the non-OPEC production is seen as falling. So there will be the biggest oil producer is Russia, and the production from Russia is expected to fall, and also UK, Norway, and Mexico have been pumping for a fairly long time. Another interesting indicator are the inventories. So the rich countries managed to build up quite a volume into their storage, and you can see that the inventories have been rising. Even the forecast is way above the five-year average, and this is another indicator that would raise some question marks. Why is oil at such high levels if inventories are so high? If supply and demand were determining the price of oil, prices would need to be around $45, $50 level if we looked at supply, demand, and inventories. But we will see that other factors have been driving prices high. In the US, the fuel inventories are also high. These are crude oil stocks. You can see how elevated they are, and the forecast is that that's going to stay high. US customers are not going to be driving as much when prices will start hitting $3 per gallon gasoline, or maybe $4. People will stop driving, and there's a similar picture on gasoline and distillate inventory. So these are gasoline inventories. They are elevated, and then heating oil, that's extremely elevated inventory levels and way above the 5-year averages. The next driver that is going to make an impact between June and 30th of November is the hurricane season. I don't know how many of you have seen the latest forecasts. We pay quite a close attention to what's going to happen. We have seen the devastating impacts of the past hurricanes, and we watch out for what's going to happen this hurricane season. And the expectation is that we may have 2 or 3 big hurricanes hitting northeast of US, northeast US. And the main reasons are that the ocean is about 2 degrees warmer than average, and that's a very good environment to produce hurricanes. You can see there that the Colorado State University is predicting 15 named storms and 8 hurricanes, which is much higher than it was last year. And AccuWeather is predicting similar number of named storms. Now, what's been behind the relentless drive in prices upwards over the last year or so? Ever since March 2009, when prices were lowest for heating oil, or December 2008, when prices were lowest for crude oil. Consumer confidence has bottomed in March 2009 and has been on the increase, and so have the retail sales. So you can see that both of these indicators bottomed around here, and consumer confidence and other leading indicators have been rising. When I used to trade crude oil and coal, I was joking with my colleagues who were trading equities, and I said, equities are for beginners. It's so simple. All you need to do is chart confidence levels, confidence sentiment and leading indicators, and then just put your money on it, and you make money before you know it. So these are leading indicators. The leading time is anywhere between a month to 3 months. There's another leading indicator, which is the Chinese stock market and the Chinese confidence levels that leads the markets by about 3 to 6 months. Another indicator is not so much leading, but it's more of a real indication of the economy, is the industrial production. And you can see how sharply that recovered. The gray area is the recession. You can see the past recession in 2001. Now the latest recession, 2008 to 2010, we know that it should really started in 2005, or the beginning was with the housing market, where too many buildings were built and too many building permits were applied for. Then we can see that the industrial production dipped and then recovered quite dramatically as a combination of the fiscal stimulus and monetary policy. We always say that it's always a combination. And the stimulus that went into the economy would have to create some sort of rebound. We may not see it on the main street or in our pockets, but you could have heard that Goldman Sachs and Morgan Stanley and the likes have been reporting record profits. So if somebody gives you 70 billion and gives it to you interest-free, and says, well, there's a concern, and the concern is deflation. We don't want prices falling. What are you going to do? You're going to start buying crude oil futures. That way you please the government, because you won't have deflation. You will have inflation. Everybody's going to be happy when inflation target is hit around 1 to 2%, and you also make some money for yourself. And then you return your bailed out money at no cost. Very simple game. Everybody knows it, apart from the people on the street.